Do you want to learn how to quickly analyze investment properties in 30 seconds or less? Wait a minute. Can it really be that easy? In this video, I'm going to explain how I have quickly analyzed thousands of properties for myself and my clients with my 3-step analysis process, and why it rarely takes me more than 30 seconds to figure out which properties make more sense to pursue and which property will have cash flow. Once you understand my entire analysis process, you'll be able to see which properties will cash flow in 30 seconds or less. So make sure you watch to the end, and you'll be soon analyzing investment properties like a pro. Hi, I'm Ron Benning. I've been a real estate agent since 1989. This is the exact process that I'm currently using for myself and for my clients to analyze small investment properties. If you're working with me or one of my partners, we will be doing most of this for you. But if you're not, I'm about to teach you how you can do it for yourself. Step 1. I use the G.R.M or gross rent multiplier, and for the rest of this video, I'll simply be using the term G.R.M when I'm talking about this concept. Honestly, you may hear about all types of other ways to quickly analyze properties for potential, but in my experience, the G.R.M is the simplest and most reliable starting place. So what is a G.R.M? To calculate a G.R.M, you simply take the price and divide it by the annual income. For example, if you had a $500,000 sales price and a $50,000 gross income, your G.R.M would be 10. Sometimes you only have the monthly income. So in this same example, if the monthly rent was $4,166, you would simply multiply that by 12 to get the annual gross income of $50,000. If you have one or more vacant units, you will plug in a reasonable rent estimate or Proforma rent to make the calculation. With the G.R.M, the lower the number, the better the potential cash flow the property will have. An easy way to visualize this is that if you had a G.R.M of 12.5, it would take 12.5 years for the rent to equal the purchase price. Some people will say, but Ron, how can this make sense when the G.R.M only looks at the income side of the equation and not the expenses at all? The answer is because this tool is a quick way to analyze many like-kind properties. When I say like-kind, I'm referring to analyzing multiple duplexes or multiple fourplexes or multiple small apartment buildings or even multiple houses. The most common mistake in using a G.R.M is that some people do not understand that the G.R.M for a duplex, a fourplex, or a small apartment building are not directly comparable, because each type of building will have slight differences in the standard operating expenses. Over time, you will come to understand these differences, or an experienced investment specialist will help explain these differences to you. Generally speaking, a single-family home or a duplex will have the most expenses that can be passed along directly to the tenant. By the time you get up to a triplex or bigger, you will start to have additional expenses that cannot often be passed along directly to the individual tenant. Some of these would be things like common area landscaping, laundry room expense, hot water heater that's in common, or in many cases, water bills that are not separately metered. At a certain size building, you will also need to have an on-site manager. So by analyzing like-kind properties for an apples-to-apples comparison, the operating expenses will be pretty uniform, at least uniform enough for the initial analysis to see if they will make the cut to move to the second round of analysis. So how am I using a G.R.M? I use the G.R.M to analyze similar asset types. In fact, I analyze all the small investment properties every week in the counties where myself and my team member are doing business. The G.R.M report on the screen was an analysis of all the duplexes that were on the market the day I was making this video. As you can see, in 30 seconds, you can compare the income ratio or G.R.M for every duplex on the market and go back and look at the properties with the lowest G.R.Ms. If you're not working with me or one of my team members, you can do the quick math I described earlier for each property you are considering and quickly figure out which will make the cut to the next step of analysis. I don't waste more than 30 seconds on properties that don't pass my first test, which is whatever maximum G.R.M. I'm willing to consider at the time. For the second part of how I analyze any property in 30 seconds, I'll have to run an annual property operating report, or APOD. This is also known as a Proforma cash flow report. This will be covered in more detail in step 3. I will adjust the gross income up or down until the cash flow before taxes is 0, which is the break-even point. And then I simply look at the G.R.M. Wow! And now I will know what G.R.M. for that type of building will break me even. It really is that simple once you understand how all of these numbers fit together. As long as the operating expenses for that type of building are fairly uniform and the interest rates don't change substantially, all you need is the G.R.M. to know which properties to pursue. If the interest rate changes substantially, in just a few minutes, you can figure out the new base level G.R.M. for a break-even by just adjusting the interest rate in your APOD report and following the same procedures I just described. Step 2 is not needed for the 30-second analysis to see if the property will cash flow or not, but I recommend doing it at some point if the property looks like it passes the 30-second test. Step 2 in my analysis process is to do a Proforma income analysis. So what is a Proforma income analysis? This is where we look at the current rents of any occupied units or anticipated rents for any vacant units. We then project going forward the short and long-term cash flow potential of the buildings. A critical component of this analysis is to understand if there is rent control in the area you are considering buying in. If you're buying in an area that has rent control, you need to get the appropriate discount or suffer the long-term weak cash flow as a result of not understanding that when there is rent control, it is the income that determines the fair price, not the comparable sales. If there is no rent control in your area, then these properties can have a significant increase in revenue with just simply giving the proper notice to the tenants. In step 2 of my analysis process, I'm going to spend a few minutes explaining some additional analysis I do to understand which properties have the best long-term potential. Over the years, I came up with a way to reconcile the current monthly rent versus the average rent in the area to see if the property has below market rents, average market rents, or rents that are above the current fair market rent in the area. I call this the Rental Opportunity Report. Now let's make the assumption that we've shortlisted the properties we want to do a little bit more research on. I start by looking up the market rents for each of the units for each property. I use a program called Rentometer. I will use the 50th percentile or average rent for this calculation. And then I place them into a program I have written that subtracts the estimated market rents from the current rents. What you come up with is either a negative or a positive number on the far right-hand side column. You could do the same thing by simply using a spreadsheet if you want to duplicate what I'm doing here. If the number is negative, that is the amount of money monthly that the property is below market or the upside monthly potential over time. If you're in an area without rent control, you may be able to raise the rents right away by simply giving the proper notice. If you're in an area with rent control, you can try to figure out how long it will take to get the rents to fair market value. This will help you calculate the discount you need to target. By taking the G.R.M. report and the Rental Opportunity Report and comparing them side by side, you can see which properties have the best long-term and short-term potential. Depending on your liquidity and the condition of the market, you can pick the perfect blend between short-term and long-term potential. At this point, if you're doing this analysis, you're light years ahead of most of your competitors in terms of understanding these assets. And we're doing all of this for our clients automatically. After this step, I might have the properties narrowed down to just a few. There's some real opportunities to be found in doing this type of analysis. If you're an owner-occupied investor, check out my video, House Hacking, Big Discounts for Owner-Occupied Buyers. I put a link to it down below in the description. At this point, we would move on to analysis step 3. Step 3 in analyzing your investment properties. I only do this for properties that I am very interested in. Running a Proforma cash flow statement. This is often also referred to as an APOD or Annual Property Operating Statement. Before I get into this, I want to mention that this is the final step for the 30 seconds to analyzing any investment property. If you combine the G.R.M information with this information, you can analyze a property in 30 seconds. Keep watching and it will become clear how to do this by the end of the video. So what is an APOD or a Proforma cash flow statement? In this final step in the financial analysis of the property, we will be taking either the actual past operating expenses of the building and projecting forward what the potential profitability of the building may be. I use the word potential because there's no way to know exactly how any property will perform going forward because there are dozens of variables that are difficult to predict, including the skill of the owner and their management company. There are also local and national economic things that can make a big difference. Depending on the size of the building, I rely more or less on the actual past numbers versus what I know to be common expenses in each category in your market. This is where a good realtor comes in who has experience with this type of sale because they will know what the typical expenses are in your market. Honestly, it'll take a little time and effort to master running this type of analysis, but it will be worth it. For larger buildings, many times there will be a document that is provided by an agent that is called an offer memorandum. Sadly, many times these documents are an exercise in creative writing and creative accounting. Unless it is clearly stated that they are actual numbers, I would take these numbers with a little bit of pessimism. I have found in my experience that many sellers in anticipation of selling a building might not accurately expense everything, or in some cases may have made an unusually high amount of capital improvements in the year or two before selling, or opposite, done very little in terms of capital improvement. So it is important to compare these numbers to what is common for those expenses in your area and for the type of building that you're going to be analyzing. Keep in mind that in most cases, the information being provided will be a best case scenario. I sold a 22-unit apartment building a couple of years ago where the agent's offer memorandum claimed it had a cap rate of 8.2%. But after analyzing the numbers carefully, I found that going forward, the building would be closer to a 5.2% cap rate. So were they lying? Not necessarily, because it was based on their actual numbers looking backwards. When financials are based on backward-looking numbers, they may be off quite a bit. For a number of reasons, in this example, the biggest discrepancies were as follows. The property taxes. The building had been bought at a lower value, and upon sale, the new owner would have to pay taxes at a substantially higher reassessed value. The property's insurance. In recent years, we are finding the cost of insurance for a new owner can double or even triple. So you need to make sure that you're not just taking the seller's cost as the amount for the insurance. You need to be checking it out for yourself in advance, particularly if the property is in a flood zone, an earthquake zone, a high fire zone, tornado zone, or anywhere else where there are a lot of natural disasters. These insurance rates are going up like crazy. Capital improvements and maintenance. In this case, the property was grossly under-maintained in the year or two prior to the sale. Each of these things made the current owner's short-term numbers look much better than the numbers that my client would be able to generate. And when we ran our own numbers that were based more on what was reality, based on the buyer's profitability, we were able to negotiate a better price for our client. For 2 to 4 unit properties, I really do not rely much on any expense information that is provided from the seller or their agent. I didn't say I didn't look at them. What I said is I rely less on them because often investors owning this type of property really do not keep as good of records, or maybe they're not running them as efficiently and as professionally as some of the bigger buildings are. For the bigger buildings, I would look carefully at the financial numbers that have been provided. And typically, I have my go-to commercial lender take a look over the financial statements too, to look for anything that I might not have noticed and to see what terms they would be willing to offer for financing. Let's take a look at a sample annual property operating report. This is a format that I use and grant access to for my clients to use too. Sometimes there will be additional fields in these reports, but to keep things simple, we consolidate certain categories together. Any categories that seem to be missing are usually consolidated into one of the parent categories. In the first section, we take the gross income of the building, and that's labeled gross income. In many variations of this report, there will be another line for additional income. This is where the laundry income or parking or other income and revenues could be added. But we simply put that into the gross income field here. Just below that is the vacancy line, where many people are using estimated vacancy rate of 5%. And in your area, it might be higher or lower. The next field is the management fee. This can also vary depending on the area, but a number in the 6 to 8% range is not uncommon. But keep in mind, this is negotiable. For larger buildings, this may include concessions for on-site managers or managers' salaries too. So when you deduct the vacancy rate and the concessions, the management fees, we will get the effective gross income. Now we will move into the second section of the report, which is the operating expenses breakdown. Some people will have more categories. I summarize anything not listed in my report here into the miscellaneous expense category. The first is insurance. You cannot assume you'll get the same rate as the current owner. Check into this yourself. This is important. Property taxes. There will likely be a standardized rate for your area. Calculate your taxes. The previous owner's tax will likely be much different from the rate you will be paying. In California, I'm using an estimate of 1.25% of the purchase price. The HOA fee, if applicable, are unique to each property. Professional fees can be things like paying our accountant or our attorney. Maintenance. Many use a rule of thumb of 1% of the value of the building annually, but obviously this will vary dramatically based on the age and the condition of the building when you purchase it. Landscaping. For houses and duplexes, usually the tenant will be paying for this expense. For larger buildings with common areas, you will need to budget that in. Advertising is likely to be little to nothing. For vacancies, some property managers charge the owners for an advertising expense, and some don't. In the utilities section, who pays what can vary by area. In the Sacramento area, most of the owners are paying for the water, the sewer, and the garbage, with tenants paying for the electricity and the gas. In situations where there are individual water meters, I'm seeing more owners billing the tenants directly. Also, if there's a common hot water heater, the owner may have to pay for all of that themselves, or maybe they'll prorate it and spread the cost over all the tenants. Other considerations for larger building include common area lighting, alarm systems, fire suppression systems. In these cases, review the financials provided by the seller or the listing agent. At the bottom of the section, you will have the total operating expenses. When you subtract the total operating expenses from the effective gross income, you will have the net operating income, or NOI. The line below that is the debt service or mortgage. It's possible to have more than one mortgage, so in some cases you'll see two lines. When you subtract the total debt service from the net operating income, you will come up with the cash flow before taxes, or for most people, what I would call the bottom line net income. There are some other indicators in my report in the upper right corner. So, what is a cash-on-cash return? It is the return you are getting on the cash invested. So what is the G.R.M or gross rent multiplier? It is the purchase price divided by the gross income. The lower the number, the better the potential cash flow. Another way to look at this is that the G.R.M is the length of time that it would take for the rents to equal the purchase price. So what is a DCR? Debt coverage ratio. This is very important for buildings that are more than 5 units because the commercial loans, the debt coverage ratio determines what down payment the lender will require. The minimum debt service coverage ratio required in an apartment loan is typically 1.25. Though in practice, the required debt service coverage ratio will typically depend on the financial strength of the borrower, the type of property in question, and other key factors. What that means in plain English is that if the income is not 125% of the debt service, the lender will increase the required down payment until that ratio is met. So what is a cap rate? You get the cap rate when you divide the net operating income, NOI, by the sales price. This is more commonly used in commercial properties. The main reason that I don't like a cap rate as a decision process for small investors is that it doesn't take into consideration the cost of the borrowed money. So while you have a cap rate that could be 4 or 5%, you could still have a negative cash flow after the cost of money is factored in. And most small investors will be using some kind of financing, so I prefer to focus on the cash-on-cash return. Lastly, I like to look at the expense ratio too, because after you run a number of these by building type, you're going to start to get an idea of what is a typical expense ratio for that type of building. And then you will be able to quickly spot properties where the expense ratios seem out of line. For the second part of how I analyze any property in 30 seconds, I'll have to run an initial annual property operating report or Proforma cash flow report like we just completed. And we'll adjust the gross income up or down until the cash flow before taxes is 0 or the break-even point. Then simply look at my G.R.M and I'll know what G.R.M for that type of building will break me even. As long as the operating expenses for that type of building are fairly uniform and the interest rates don't change, all you need is the G.R.M to know which properties to pursue. If the interest rates change substantially, in just a few minutes, you can figure out the new base level G.R.M for a break even. This is exactly why we regularly do the G.R.M report for our clients. Wow, that took a while. But for those of you still with me, I hope you learned from this video. If this is your first time to the channel and you want to know everything about buying and selling small investment properties, please subscribe to the channel. Whether you're planning on selling in 7 days or 7 months or buying in 7 days or 7 months, give me a call, text, or schedule a Zoom meeting. I'm happy to go over all of this and answer all of your questions in more detail and to help you plan a smooth investment purchase or sale.